do, I gotta have it. I ain't even playing, got a really bad habit. If it moves, gotta grab it. Fuse like a magnet, lose, won't have it till I'm doomed in a casket. I ain't playing, got a weird mind. If you work 8 hours, I'ma work 9. If the shit tastes sour, you should taste mine. I'ma stay in power for a long time. Get up, nah, I ain't a quitter. Toss me the ball, I'm a really big hitter. Big picture, I'm a straight killer. Rising the song to the highest bidder. Got juice, got gas, I'ma move fast. New shoes, new tracks, like who's that? I'm new, come back, better than last. Yeah, it's a new me, never gonna look back. Never gonna look back. Cause damn, I was built to last. You move slow and I move fast, and that's facts. Only I can make a change. Slowly take a step today. I will never be the same, cause that's what it takes.
All right, everybody, good morning. Let me get May up here next to me. How you doing, May?
Morning, guys. How are you? Happy Sunday.
Happy Sunday. In today's live stream, May, I've been getting bombarded for a few months with people wanting an update on SOFI. And, you know, I have been a trader of SOFI for the last couple of years. And you spend a lot more time going through their financials than I do. So I thought maybe between the two of us, we could hit all the bases today and maybe take some questions from folks who have an interest in SOFI as well. And yeah, that's kind of the agenda for today. Just share a couple thoughts and do some live Q&A. How's that sound?
That sounds great. I've been really fortunate because there is a really strong SOFI community on Twitter, and the controversy on it is very real, and it's really great to have those folks. You know, you've got some really smart people on both sides of this, and let's talk about it. Let me know what your folks are thinking, because you know.
I just want to, do the standard disclosure. Whatever we discuss today, guys, is not trading advice. This is May and my opinion, our own personal analysis. We may or may not have a position in the stock. I don't know if May does or not.
I will just admit it. I'm long the stock, and I have call spreads on farther back, and I may just have outright calls farther back at these levels. But
I'm not trying to hide from it by the way I worded that. I didn't know if you were in it or not. So I'll show you my current status. Let me put it up on the screen. This desktop. So here's the long-term chart of SOFI. It went public in like June of 2021, May?
I think that's about right.
And I bought some in mid 2022. I bought some near the low in December 2022. Yeah. I sold for a gain in September of 2023. I know this chart's kind of hard to see. And then I just recently started rebuying it. But May, I look at financial statements every day. When I go through something like a SOFI, even for me, my eyes start glazing over.
SOFI financials definitely have a couple of kickers. First, bank financials in general, I think, are oftentimes expressed so differently from bank to bank that if you're trying to just learn the banks, if you're not aware that they present their financials a little awkwardly, it is incredibly difficult. And then SOFI does use, fair value accounting versus CECL accounting. And for a lot of folks, that is a core component of the controversy. I would say too that with respect to the chart that you showed, your entry point and exit point was kind of very much so right, because the story of SOFI really is that the part of the chart that extends before it becomes public is really the SPAC that they use to, bring themselves public. And there's a lot of crazy stuff on the internet on that. And in fairness, I'm always really sensitive to SPACs, period, because especially in a crazy bull market like we had in 2020, it's very common for you to get a lot of, basically graft, for lack of a better word for it, as people use the SPAC vehicle. In the case of SOFI, though, they actually used it for its purpose, which was to make it easier to come public. And especially as a bank, there's certain types of cash that you have to have in order to be acknowledged as a bank and be allowed to exist as a bank. And so when they came out, the SPAC vehicle made sense. Unfortunately, because they came out as a SPAC, all the SPACs got clobbered. There it is. Now, do I think that when it first came out, the valuation was aggressive for me? Yeah, for sure. It was. And that's because to me, when I looked at the financials, even from the very first time and listened to the strategy, it was always clear to me that it would become a bank. So I have never been confused about SoFi being a bank. For a long time, when I first started posting, I was very confused by folks that would post and use metrics that were not common to a bank. They're not terrible metrics to use, such as EBITDA, et cetera. It's just that it kind of it was confusing to me to use them because interest income for a bank shouldn't be removed. Now, that said, SoFi's EBITDA presentation is usually an adjusted number, so they're still treating interest income like revenue when they present that EBITDA number. So it becomes, but nonetheless, does that make it really fun to read SoFi's financial statements if you haven't been enjoying precisely what they've been trying to do? Nah, it's not fun to read. Once you finally get your bearings straight, though, it's not so bad, but it does take a half a beat for sure.
Can we just flip through real quick some of these slides from their most recent earnings, and maybe you can talk to a couple of those, and that'll get us started. Yeah. I have a couple of concerns that I want to ask you about that may or may not be in these slides, and then maybe that'll be part 2 of what we talk about.
No problem.
Things that I typically worry about in any company. And yeah, I mean, in 2021, when SoFi came out, everything was getting hyped back then. So it was normal that it was going to come out of the gate strong. And we saw just about everything pull back after that, right?
Yeah.
That's why I waited on some of these stocks. I think SoFi has a good market presence. Look at the number of member growth from 1 million in 2020, 2.2 million in early 2021, up to 8 million members now.
Yeah.
Nothing wrong with that.
Absolutely good.
Number of products. I don't know. What do they mean by products? I don't remember.
And then actually, let's go back to member growth just for a second. The key thing to understand about what is SoFi, every single bank, every single financial organization has its own, let's call it customer base. Okay. Yeah. Just to make it simple. It's really important to understand that when you're looking at SoFi, their average credit score is about it's over 700. Sometimes I see it quoted at 740. No bank really usually gives you the answer to that because it's very much a moving target. One set of loans could actually change what the average number is, but let's call it well above 700, probably close to 720 to 740. That is a very different view versus other banks. So to give you a sense for it, since SoFi would be best compared to consumer lending companies, such as the larger cap names would be like Capital One or Discover, which is now being purchased by Capital One. Those banks tend to have what would be considered prime membership if you wanted to try to do apples to apples. Now, because it's a bank and because of the nature of that business being more mature, they don't have a concept of membership because they didn't come out of the fintech world. Right. But if you were trying to compare apples to apples, this membership edition gives you a sense for who is their customer base. The customer base of SoFi is significantly higher credit quality than something like a Capital One, which would typically quote its loan book somewhere like 600. So what's considered prime. It's not like higher prime. It's not subprime. It's like smack in the middle, 600, with 650 being considered truly prime. So they will tend to be 600 to 650 depending on the macroeconomics of the world. Other banks, like even a JP Morgan or something like that, are still going to come in closer to 650. So really, this piece of the story for SoFi is so often forgotten because the only other real financial that looks anything remotely like that would be American Express, which is almost the bulk of what they're doing is business, or an individual that's attached to a business somehow.
Okay.
Sorry, didn't want to it's a lot.
No,
Just wanna make
that's
sure.
good extra
Yeah.
color on that.
Oh, okay. So your simple question on products really has to do with all the products of the bank. It could be the financial services. So they're starting to do, whatever it might be, from lending to just having a deposit account to money market accounts. So they consider all of that products. It's a little bit of an awkward way to count it.
So if a customer takes a personal loan out, that's a new product addition.
Yeah.
Okay. Galileo is their payment processing, right?
Yeah. And this is very exciting in some ways, and it will make it very hard to compare to other financials. So Galileo, if you think about it, for folks that are really knowledgeable about the sector in general, would be, in my opinion, most comparable to something like Jack Handy or Jack Hardy. JKHY. I'm sorry. What is the name of that ticker? Sometimes I remember the ticker.
I don't know. You got me going on a Saturday Night Live tangent there for a
I
second.
remember. Sorry, part of me remembers that because that used to be my favorite book. But whatever the ticker is for JKHY is actually the best comp to this day. Look, it's Sunday. The caffeine is still coming into my body. I apologize. So that would be the boy. That was a fun Saturday Night Live sketch, though. No,
Deep thoughts.
Jake. Sorry. Still to this day, there's a part of me that always loves that. So JKHY, whatever the name of the company is that matches that ticker, it's in the S&P 500. And even though they do a bit more, particularly on the consulting side, Galileo is probably within their space within fintech. Realize that what then that looks like on the income statement balance sheet that becomes very controversial for the bears is that they did a lot of upfront CapEx for that, capital expenditures. So for folks that there were a couple of weird things on free cash flow, and I'm like, you never look at a bank for free cash flow. It doesn't even make sense because most of what they're doing is in cash flow from financing, not operation, whatever. But it doesn't matter. Regardless, CapEx should be higher for them before this year in particular, because they've actually done a lot of the build out already. And also the financial services operating income will reflect the fact that you built this business
Right.
early, and thus you can see the account numbers, growth, et cetera. But Galileo has risk modules to it, credit modules to it, various ways that they can try to do, security on accounts and then some. It also is something that other banks license. It would be an attachment to something like Zelle and pieces of it. There's a lot of different things that this business has that it will continue to evolve into, but it means that your capital expenditures will be higher. And it also means that it will impact intangible goodwill, those numbers, which is usually where you put businesses that you put a bunch of spending into and then over time sell into other banks that do not have the ability to create this for themselves. So if you think...
Isn't it also like their engine for customer bill pay type service and things like that?
Absolutely. So you could see it being a regional bank would not have enough capital at this point, given what's happening with interest rates, given what's happening on their held to maturity portfolio, given all these crazy things that are happening. A regional bank will not be able to do the spend. They would find an outsourced partner, and this would become revenue for SoFi along with anything else that they're already processing on their own platform.
Okay. All right.
That's what this business actually is.
Lending and financial services products, again, two very good year-over-year growth charts by quarter there.
Yeah.
Financials.
Going forward, I would anticipate until the rate environment improves, I would anticipate the right side to do better, the guidance to be more predictable on the right side for just this next quarter until we start to get rate decreases. And that's really a macro call. All the banks this quarter, in general, even for SoFi, the number one kind of negative catalyst I'm worried about is the regional banks actually coming in below what they've guided because the rate environment has just been so severe for them.
Right.
and that would be the left.
Financial services productivity loop. I'm not sure what this chart is telling us here. There's a lot going on here. Can you make any sense of this?
Oh my goodness. I would say, you know what? I don't.
Ratio of financial services to lending products.
Oh, I think this is their metric, their internal metric of just trying to understand or just trying to explain how it it is really good to go through this with you because people have told me before that their presentation is really hard. Their presentation doesn't match their investor base. And I get it. I actually think I agree with you. This is really, really hard to understand.
Yep.
What they're trying to show you on here is some greater, more significant detail of how they're doing return on capital. But it's taking me more than a half a minute. I'd need a minute to really.
Yeah, I'm gonna have to go back and spend some time on that slide. We're used to seeing slide decks and investor presentations. This is not a normal one that we see, right?
Yeah, and that is really the criticism. And I hadn't fully appreciated it because so Anthony Noto, by way of background, he is a Goldman guy as well. And he used to run TMT banking for Goldman Sachs, investment banking. And then he ended up at Twitter, strangely enough, as I believe the operating officer before going to SoFi. And in fairness, it's not really talked about. I actually think he cleaned up a lot of what was the old lending business. And a lot of folks still pretend like the old CEOs and their thought process around lending still exists at SoFi. SoFi looks a lot more like a normal regional bank with this, to me, it looks a lot more like that. Now, that may be controversial to some of the other hardcore SoFi folks, but he has a tendency to give a lot of extra detail. I think he does it in defense of the company, but because it ends up with slides like this that are not that straightforward to walk through, I do think it freaks people out sometimes.
It says down here, May, see footnotes for detailed explanations. So we'll have to do that offline later.
Yeah, sorry about that, guys.
Quarterly performance, adjusted net revenue. We had a little bit of a slowdown in the most recent quarter, and adjusted EBITDA, the same thing. But overall, over the last 2 years, nice upward momentum.
Yeah, and you're going to want to still compare it quarter over quarter for them, because if you think about, there is seasonality to banking. You do get like there's a few things here going on. First, you do get seasonality to lending because people tend to spend more in credit card receivables or deal with their financial situations so that they can have a nice Christmas.
Right.
Fourth quarter always will look a certain way on the lending book regardless. Now here, you also have some weird stuff that's going on with student lending that kind of had the company pausing in different places. Still, the other thing that is true, not just of SoFi, but of all the regional banks, is that because rates have been where they're at, you do have people pausing on the loan book. Now, that we can come back to, but that dynamic is important to understand for SoFi or really all the regional banks, because it can cause near-term weakness in the sector and therefore potential weakness in SoFi.
Q1 2024 non-GAAP results versus guidance. So they had guided between 550 and 560. They came in at 581 on adjusted net revenue. EBITDA 110 to 120 guidance came in at 144, and GAAP net income
crazy high.
Yeah, 10 to 20 guidance came in at 88. Wow.
Yeah, stock traded up for a bit and then traded straight down.
So we're going to talk about why it's gone down a little bit and why I think it's struggled over the last couple of years. But let's push through a few more of these slides just to kind of set the foundation of the Q&A part of this talk. Guidance for Q2, we expect to deliver 555 to 565 in adjusted net revenue, 115 to 125 adjusted EBITDA, and 5 to 10 in net income.
Yeah.
Do you know? Do you know what the market was expecting versus what they issued as guidance?
It was I think this was slightly in line, to be honest. And that's why it traded up at first before coming down to maybe even slightly higher. The thing that people then freaked out on is the declining. They are guiding towards a slightly smaller loan book. And
Okay.
really, the way that you have to understand that is that if rates stay where they're at, then, and you are, well, let me take two steps back. It is definitely the case that because of what's been happening in rates, you have a decreased demand for loans. People are just waiting to see what happens. And when you have shrinkage in total demand for loans, you also happen to have a bunch of banks that are doing any number of things to create loans on balance sheet. And there's a few dynamics that are at work there. But what happens is it is smarter for a bank that is high stacked coming to the poker table, so to speak, to just not reach down in credit quality to make more loans.
Right.
So now what's been interesting, and I've been trying to observe this to just understand how this next quarter will play out. How next year will play out is a totally different thing, but how this next quarter will play out going into earnings, both for SoFi and the other regionals, is that historically, we have seen that some banks will reach down in credit quality because they believe that if they can lock in loans at a higher rate as things decline, then when they go to securitize off balance sheet, when they go to try to even remove old stuff off balance sheet, they end up, when you do the averaging out, I'm going to try to keep it somewhat simple, in a really amazing spot because the market will be willing to pay the market, trying to think how to say this without a lot of jargon. So if you make a loan at 5%, then they decrease loans to 4.5%, then obviously that 5% loan is great because you
Yep.
actually, right? So what they'd like to do, all banks would like to do, is have more 5% loans. And so you do have some guys just doing that right now fairly aggressively. And the trick is, if you do that, watch your credit quality. Don't reduce credit quality. And what SoFi did was go ahead and say, this may be not as straightforward to do. So let's go ahead and say we might have 90 something sub 100% of the same size book that we had last year. And for whatever reason, there's a couple, some of the bearish folks on this went crazy, like actually crazy. Some of the things they
Let
say.
me guess. The story was SoFi, can't get any new loans.
Or growth is an issue.
Right.
Because they are using fair value accounting versus CECL, there is a little bit of a dynamic to that.
Okay.
But they kind of have the wrong dynamic. Their dynamic is that you do benefit from writing more loans in under fair value than you do in CECL. Where they've completely missed the boat is that the way that you would see it being a problem is if you couldn't sell those loans into the secondary market. And so you'll see 1001 posts that you'll see me then writing against that that the marks are wrong, that they're way undervalued, blah 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 blah. And I'm like, hey, when it comes down to it, if these were bad loans, they would not sell in the secondary market. And they're like, no, because they're keeping all the bad loans on balance sheet, blah 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 blah. That to me flies in the face of what a securitization does, which is it blends the rate of all the loans that are put into the pool. In other words, you would be most likely to put your bad loans in and write new good loans to cover up any errors from the past.
So that spin on it that you had, that they took a strategic executive direction to not add to the book with more lower quality loans, is that something that they guided, that you read or you heard them say?
No, it's just the nature of that business. Like if you know that you have this really funky market and you can see the demand for loans drying up, then there's only one of two things you can do to maintain the same size book. You can either stretch your hand downwards in the credit quality spectrum, or you can try really hard on advertising to offer things to people to take out debt that they don't need, to try to inspire them that that debt is actually worth taking out. And
Okay.
that's how it works every cycle. So, I could be wrong. Of course I could be wrong, If I'm wrong, it's that. Or alternatively, and more likely the case, I'm not wrong, but SoFi might have been wrong and how much book shrinkage they have. If the latter part, which I think is far more likely, is correct, then the first regional banks that come out on the 12th, this coming, in the coming weeks, will start to show loan book shrinkage greater than they guided to the street, because it is very hard to guide supply and demand when you have this much Fed uncertainty on what's happening. So these guidances would have had to have been given either at one of the conferences that happened that wasn't really oriented towards banking, was more fintech, et cetera, payments, or it would have had to happen in the last quarter before we knew what was going on with the latest economic data.
Can we talk about the full year guidance slide here?
Sure.
I have a question for you. On towards the bottom of the list here, they talk about 800 million to 1 billion tangible book value growth. When you're looking at a bank and you're looking at the balance sheet, and tangible book value by definition is taking out intangibles, right? Like goodwill.
Yeah.
Is there something else that in a bank or in SoFi's that we're looking at? Because I'm having trouble coming up with a tangible book value comparable to what analysts are talking out there on SoFi.
Yeah, it's really weird. When I calculate the tangible book value, I get 1.5 times book. Now, there are some analysts that are trying to argue that because they're using fair value instead of CECL, that the loan book is mismarked. And they're using crazy numbers. They're saying like it's mismarked to the tune of 20%. No, that's actually not true. I mean, they would have literally had to have sold nothing off the book for the last 2 years. And it's crazy because they should know better, because they're even stating the duration of the loans as being 1.5 years.
But there's no other definition for a banking balance sheet, is there?
1.5 times book value.
I'm talking about the definition of tangible book value. It would be your assets minus, not counting goodwill, right? Basically, assets minus liabilities.
Yeah, assets minus liabilities, then adding back in or adjust. Let me say it differently: assets minus liabilities, adjusting for any intangibles, et cetera, right? The other way you could think of it is shareholder equity plus an adjustment for or minus, depending on what's going on, in intangibles and goodwill. Yeah, you're not wrong. You are correct.
So
I mean, some of this stuff is actually just completely wrong.
It becomes important as we go into the second part of this discussion, because I see a lot of analysts trying to value SoFi's price based off of book value.
Yeah.
And also, as you probably know, they've done a lot of dilution since 2021, adding additional shares.
Yeah.
And they have convertibles hanging out there.
Yeah.
And so as a trader, that's something that I worry about. Like I want to get my best entry, but I don't want to be stuck holding something for a year or two if they're just going to keep on holding book value down per share by issuing more and more shares.
Well, the fully diluted share count still brings you to 1.5 times book when I do the calculation. A fully diluted share count should include the converts.
Oh, okay. But there is that, yeah. All right, so maybe we'll come back to that in a second. Anything else jump out at you here on the 2024 guidance?
I would just mention that the capital ratios at 16% are a place of contention and argument. Even if you did this crazy analysis that the folks are doing, they're suggesting that capital ratios are at 9 or 10% for SoFi. Now, I actually think this is way too much adjust here and there, because then if you make them all comparable, you end up with a bank that's holding 9%-ish from their calculation. I don't agree, by the way.
The Bears?
The Bears, yeah, they 9% in capital, CET capital. But I would just I would just have them actually take a look at what most regional banks are holding in CET capital. It's about 9-10%. And that's actually quite elevated for them. Historically, they'll hold 8%. And then some of the lesser regionals will hold much lower than that, especially in this environment. So I have no idea why they are so adamant and passionate. Some have actually tried to suggest that that CET capital ratio is low as 6% once adjusted, but they really are arguing very strongly that there's a loss in the book. And I'm like, again, this is a seven, even you will, like, even the bears will admit this. They admit, they suggest that the average credit, I'm like I am only saying the credit rating is above 700. They actually, in their written statements, are suggesting that the credit score is 740, which is way crazy high. Do you know what I mean? For a blended rate of this many loans that you're doing, it's insane to me. But
Are those people, when you're talking about the bears, you're talking about people that we could find in your comments on X?
yeah, I think some of them have fake accounts. It's like the same thing at AMC, but there is actually a proper analyst in theory at a very small research shop. I can't say I'm the end all be all of knowing all these research shops, but it wasn't one that I really knew well. But he has put out a lot of information on it. I think he's even done something I've never seen an analyst do, which is do a YouTube video on it.
Oh, really?
Yeah, I've never seen a street analyst do a YouTube video before, but there it is. Very cool. I'm not going to take it away from him. If anything, he's probably forward looking, because I think that these things should probably be on YouTube for both retail and institutional to enjoy. I don't see a reason why institutional and retail should be so separated. But he definitely has a very bearish argument. Unfortunately, the moderator that's giving it to him, I think, may not fully. He may not be the best moderator, because sometimes he pauses the conversation in spots where I'm not sure he understood.
What's the guy's name? Do you remember the analyst?
I'll have to back channel it to you when I get a chance. Yeah.
All right. So here is the guidance for full year 2024 on diluted EPS and tangible book value growth. And you can see the obvious improvements from 2022 and 2023 to where they're going in 2024. I'm more thinking in my head, like, what's 2025 going to look like?
Yeah.
And what's the worst I got to suffer through, May, if I'm trying to start adding some SOFI now? Is it safe to add in the $6 range? Or there's the analyst out there, you've seen this guy, he's got a $3 price target for SOFI.
Yeah, I mean, if he has
one outlier analyst.
Yeah, if he's got a $3 price target on SoFi, I'd love to see what his price targets are for the rest of the regional banks, to be honest. What I would say is that I am interested wherever I can get it at the same price as the CEO buying.
Well, that's an interesting point.
And so I'm cautious above that price.
And Noto's been buying recently, right? I was looking through all the insider purchases. I mean, there were some tax sales by different executives, as we always see with their awards and stuff. But didn't he do a buy recently?
Yeah, he's done a few of them, I think, over the last few months. So that's where I'm intrigued. And I do think that the thing will be volatile, mostly because the uncertainty in banks in general is very volatile. And the lending market is weird right now. You know, if people just don't take out loans, it's actually the right call for a person personally, and they should do that. And then you still have economic uncertainty. So you might have a reduction in folks thinking about their future and the certainty of that. Both those things, so both the uncertainty of the future and this very weird dynamic that we have in the actual rate itself, create what could be a slowdown. Same thing as if you had a slowdown in retail. So that is a real legit concern going into an election year where everything is so strange. I say that should, in theory, hurt all of the other banks just as much, if not more. The only bank that I think that could potentially not hurt, but I'd be surprised if it didn't hurt it a bit, would be the investment banks, JP Morgan, Goldman Sachs, Morgan Stanley, because those banks have other businesses that can kind of support support the revenue of the company. SoFi really has as its largest revenue stream the consumer bank business, consumer
Yep.
lending in particular. Regional banks mostly also only have this business. Some regional banks, especially the ones in the S&P 500, also have an asset manager investment banking arm that may be able to do better than expected in both cases, so long as rates stay high and so long as companies are tired of waiting to try to actually grow their business, which is what we're seeing.
Is there anything on the balance sheet that jumps out to you here that you want to point out that maybe makes SoFi different?
The biggest thing, there's a couple of things that I would point out. And it's a little bit hard to see here. The first thing is the point of contention really is the loan book. Okay, either you believe that the fair value accounting is, and also that the am I by myself in this really quick? I don't know where Tony might have taken himself off screen.
I was trying to make this
So-
bigger. There we go. That's what I was trying to do. I wasn't trying to take us off the screen.
So
ahead.
either you feel that the loan book is going to continue to have buyers for it, and that the fair value is not down 20% from this, or you don't. And we'll know that in the next quarter. It's very hard to know. You can kind of notice the loans held for sale at fair value versus loans held for investment. The part that they're finding contentious is the loans held for investment. If you compare that to other banks on the size of it, that already gives you a sense for how weird the argument actually is, because especially for some of the weaker regional banks, the amount, that mix, that ratio is very, very different. You know what I mean? So
Yep.
it's actually in quite a lot of banks, it would be reversed. You would have 15 million or billion, excuse me, held for investment, which is basically the held to maturity that everybody's still on and on about. And you'd have the smaller number be loans held for sale. And that actually is the definition of the problem currently that I have indicated completely separately of SoFi for what happens if we wait for too long to lower rates with respect to the health of the banking system. Now, the thing that's a little bit hard to see on this version of the balance sheet, but is really easy to see once you open up the other version, the more complete.
I have their full balance sheet. If you want to, is that
fabulous.
the one you want to look at?
Yeah, I think there's one way that they write it, and only a handful of banks write it this way, so you can very, very clearly see what the spread is between the rate that they receive on the loan book versus the rate of their funding cost. And I actually wish all banks were forced to do this, but this started to show up during Silicon Valley Bank. PNC was one of the first that I really observed it clearly in, even though there may have been some other banks that also were already stating it this way. It's not this. It's you might need to look in their 10. They're either their 10Q. Is this the Q?
This is the Q.
Yeah. See if it's in their press release. They may have put it there, but it basically will show you precisely what its funding cost is. Here, let me. Oh, that might be it. Let me see. Nope. I think it might be. Yeah, you might have to go into their website and just look at the actual.
All right. Well, maybe you can pull that up since you know what you're looking for, and
Yeah.
let's keep pushing on here. Can you just explain to the folks who maybe aren't as familiar with banking balance sheets the difference between loans held for sale and loans held for investment?
Sure. Loans held for investment, or let's start with loans held for sale. The business of banking is not actually to make the loan and hold the loan. It can. That's what makes it very different from the business of origination. The business of origination, which is something like Upstart, they're not supposed to be holding anything on balance sheet. They're not supposed to be making money off the loans that they write. They're supposed to literally be passing off the loans to someone else.
They originate the loan, then they sell it to someone else.
Correct. So
Right.
loans held for sale is that business. I am originating the loan. I am writing the loan. I am selling it to someone else. It will not stay on my balance sheet because I have a buyer for it. Okay. For a bank though, they absolutely, if they write a set of really great loans, they can hold them as part of just income for themselves. And so that's what loans held to maturity or held for investment are. And they could be held because they don't. So the loans that you would typically easily get off balance sheet are things like conforming loans, right? So something like a mortgage that conforms completely with Fannie and Freddie. Even the government is a buyer of that. You know, like there's lots of buyers of conforming loans that follow a certain perspective. There currently in this environment are actually a lot of buyers of certain types of CLOs actually it's just collateralized loan obligation, but of CLOs that are specifically consumer lending receivables. Okay. So because that ends up with a significantly higher rate, but the default from a historic perspective has been within a tighter range, you actually are getting people that prefer the buffer of that and having more of that right now as we start to move into a declining rate environment and potentially a fiscal stimulus environment, because that loan book, if you think about it strategically, would give you a high rate, and you'd want as much of that as you can before they start lowering. It's actually as simple as that. I don't know if I'm saying it.
Okay.
Yeah.
That's a good summary.
I apologize.
Vadim says check page 67 in the 10Q. Thank you. I'll pull that up in just one second, Vadim. While we're still on this slide, May, do you have any concerns about the convertibles 2026,
I love the
2029?
and I'll show you as soon as I'm pretty sure Vadim is really good with his SoFi stuff. So he probably does have the right page that I'm thinking about. Do you have it?
I'm going to pull it up, but
Fabulous.
I have the convertibles highlighted. While I pull it up, do you have any concern about convertibles?
No. If anything, it will be even more clear once you get that page pulled up, because that page is kind of the big, it's this page, if you compare it to something like, so I did a post on Twitter just to show you what this page looks like relative to Fifth Third, who also does present its financials in this manner. So, okay, so here it is. That's perfect. I knew he'd have it. Thank you, Vadim. You're the best. Okay, so what is this page? This page re-gives you, for lack of a better way to say it represents the assets and liabilities in a way that helps you understand how much the bank actually makes on its assets. Remember that when we're talking book value, we're talking about the fact that the assets make money for the firm, right? And so in the 3 months ended, you can compare it to the previous year. So this wonderful analysis that they provide, and not everybody does, Fifth Third does, PNC does, but I don't think you can find it in JP Morgan. I've looked before. You won't find it in quite a lot of banks. So this is one of the things that it gives as an extra. And it's part of why I think sometimes people misread it or misunderstand it. So at the top, for a bank, all of the loans it writes, those are its assets. And then there's some other stuff. And so you can see the total interest earning assets yield about 9.76%. The consumer loans are doing 10 and change, investment securities, et cetera, et cetera. And you can see that that is significantly higher than the previous year. It's almost 114 basis points. Do I have that right? Okay, so those are your two numbers. So this is actually part of why there is a complete silliness to what the bears are saying, because they're saying that the book is actually weaker, and that is like, in order to say that's true, you are basically saying that management is lying on this page, and either they are or they are not, and we will find out. Okay, so that's that's part one. Part two is, if you look at their funding cost below, this is true for every single bank. Funding cost went up. But let's actually then investigate the components of that funding cost, right? The first thing is interest. So 440 minus 386 gives you an increase in funding cost of about 66 basis points. So simple question. You can look at this as revenue on the top and and cost of goods sold below. So did cost of goods sold increase less than revenue? The answer is yes, right? Because we only have a 66 basis point increase on average. Okay, so now you have to kind of adjust the mix, et cetera. But on average, you have a 60 point basis point increase on your cost, and you have 110 14, excuse me, increase on your yield for your assets. This bank has net interest margin expansion. That
Right.
is actually the opposite of what I saw from most other banks.
Okay.
Okay. So that's the first part. Now, the Bears have things to say about that. I respectfully disagree. Okay. Because even if we were to then turn it into their version of this, I respectfully disagree that that's true, because it really requires that either the duration is much longer than they think, or alternatively, they are not able to sell any of this off the balance sheet, which is just not what I'm seeing. Okay. And we can see that again in the previous section on what's going on for held for sale. Additionally, if you look at this, the convertible shows, let's see, liabilities. So first of all, you can kind of see that the demand deposits increased dramatically, and the
Yep.
rate that they're charged on that is lower. Also not something you're seeing at the other banks. Okay. Now this 4.56%, we all know that on the savings, they do something quite competitive, as well as on the time deposit. So those two we'll have to see. That's part of the future story. What will SoFi do as rates start to decline? The other banks are offering a much lower rate. They probably will have to still increase their rate on time deposits. SoFi's already so high. Will it just maintain, or will it actually improve this NIM, this cost of goods sold, by decreasing rates? We don't know. No guidance has been provided. And my suspicion is that will be 100% a function of what their competitors decide to do and the degree to which they feel like they might want to take market share. Okay.
Yep.
The securitization of debt, if you look at it, on the right, you see 477, on the left, 440. Other debt, you see 281, 304. Now, it's a little bit hard to see, but the convert is one of those two, if I understand correctly. Videm, I know you know this cold, so correct me if I'm wrong. I'm totally comfortable with that. But what they really did was stabilize capital on debt that was going to come due, so that they would have plenty of cash, so that if the rates started to decline, more loans had to be made, that they could lock in a borrowing cost that's much lower than some of the other long-term debt that they had. So on a blended basis, they end up with only a small increase in total debt funding cost.
Okay.
Okay. And this is what, if one has criticism on doing the convert, especially given the rate of the convert was under some of these things, you would look at this and you would decide, is my blended rate lower? And how am I holding up on my assets? And how am I holding up on my assets is both, what is the interest that I'm earning, number one, and number two, what am I seeing in the way of losses?
You know, the world I come from, dealing with retail investors and a lot of the stocks that they like me, when we see convertible debt being taken on, it's typically a sign of not typically, but often a sign of a distressed company. So that was my first concern. Like, do we have some issue here that's not jumping out at me?
No, if you think about it, corporate debt right now, even for high grade, is still going to be the risk-free rate of return, which is always U.S. Treasuries, plus something else. So taking out convertible debt, which is going to be below the Treasury yield, is kind of the right call if you're a bank.
Yeah, the rates on that convertible debt was super low, right?
Yeah, it was. And remember, the whole, like, you learned about in school, this concept multiplier effect. What is that concept multiplier effect? This is the concept multiplier effect. It's, what is the rate that banks are borrowing at relative to what they can make the loan for? And to the extent that the loans are then sold off the balance sheet, that is the actual mechanism, or at least one of the mechanisms of the multiplier. So if you have a interest rate environment that is like crazy high relative to what, let's call it, mortgage loans are, right? Because if you look at this, you've got some investment securities, which is probably just Treasuries plus at 5.34%, what they're yielding, right? So at that rate, if I were to then go and use corporate debt, I wouldn't be making any money. But if I'm using convertible debt, I'm making money at that point.
One to watch says
buy
Boy,
back.
do I have a lot to learn. This guy's looking at a financial company's financial statements, the balance sheet, especially. This is the deep end of the pool, in my opinion, May.
These
Like,
are hard. Okay.
these are hard. I look at, like I said at the beginning, I look at financial statements every day, and this stuff still makes my head spin because I don't traditionally spend a lot of time looking at banks, and there is a lot going on here.
Yeah.
This
Now,
is not simple stuff unless you do it every day. If
no.
you're looking at market makers or banks, Citi, American Express, any bank, if you do that every day, this is probably easy stuff for you. But even for me, this is not easy.
Yeah. I mean, I would say this. Is there it really comes down to, and if I was to simplify if the bears are right, there is something very strange about the securitization, and they would literally almost have to be lying because you are seeing the loans come off. You are seeing securitizations in the marketplace being sold for SOFI, no problem. You are seeing approximately, I mean, they are actually giving you a lot of extra information to try to help you understand how they're coming about it. You know, I have stated this to other people that I think that if the bears are right, it will be for the wrong reason. And it will not be because necessarily they were lying and doing all this crazy stuff, but because the rate environment has forced a scenario where you have banks being very competitive in this lending environment, even though they really don't have the balance sheet to be doing that. And they would be doing that because they're worried that when rates start to decline, that they won't get the opportunity to get that extra yield, right? So if you're a bank and you're strategic and you're like, okay, technically we're running the tightest we ever could have because we've got a lot of held to maturity. So technically we shouldn't be lending. And usually what we'd be doing is just making the mortgage rates so high that no one wants to borrow with us, essentially, unless they are willing to give us a lot of extra money. But because rates are declining, let's go ahead and try to get those loans because eventually the decrease in rates is actually going to give us more spread. I don't know if I'm saying that in an easy enough way.
Yeah, let me just ask you, maybe, because the value of doing talks like this with you is you and Vadim, thank you. You guys help us know what to look at that is important. This average balances and net interest earnings analysis, is that a typical chart we'd see in any bank's financial statements?
Within the S&P 500, only about a third to a half of the banks provide this.
Okay.
That's why I really, and among the smaller banks, I mean, your guess is as good as mine. During Silicon Valley Bank on the blow up, magically this appeared in most statements, but it wasn't, I wouldn't say that this is a required report for the filings each quarter. And I definitely,
but it's helpful to us, right, as investors to.
Absolutely. If you're trying to just answer the question very clearly, what is your net interest margin, which basically is kind of like gross margin? I'm going to say kind of like, some people are very stickler for words. But if you think about it, what is the cost of the money that I have? And
Right.
then what am I lending it out at? If that is your jam and that is your deal, then this is the best way to demonstrate it by product that you sell, by area that you sell stuff at. Now realize that this is what you'd look at for the banking business, which is the largest piece of SOFI. You would look at something different for the financial services business, which is much more fee-based. And
Yep.
also, you got me on that.
Yep. Okay. Let's see if they have the income statement over here on the. Did I just pass by it? Well, let's look over here then.
Tony, do you have a better way to say it than I do? Because I'm worried I'm not saying it in the easiest way in spots.
No, I don't.
All right, and I know you're not shy.
If I did, I would. Trust me. I'm trying to swim as fast as I can to keep up with you here, May.
Oh, that's too kind. You're a pretty fast swimmer, so I think that's it's very kind of you.
Where is the damn income? Oh, let's just do this. And the other thing I have, where I always start out at, May, is just something simple like this, but
It will
I
always be a hot mess. It won't. Bank
I
finance.
worry that this is not really giving
Yeah.
us the true picture, right? Oh yeah, everything looks beautiful here. When we just go look at these pretty charts, everything's perfect. But then why is the stock going down?
Yeah.
So
Bank financials fit poorly into these types of things. If you go to actually even your income statement, you can kind of see why. So,
all
like
right,
non-interest income right there as a data feed, it won't read correctly into any data feed. That's part of the reason. Because remember that for a bank, unlike for other companies, interest is actually an income, it's not a cost. There is interest income that they might be paying in other places, but because you've got this word interest coming up twice and these data feeds aren't very smart, it ends up looking like a hot mess every single time you try to pull it into a data feed. So the way that you would read this at the top, you have interest income from the loans and securitizations,
yep.
and interest expense to get net interest income.
Net interest income.
63,193. The second set of lines. Yeah, you were on it just a second ago. 263,
Oh,
190.
26. Okay.
Okay, that's total interest in. Oh, sorry. And then right below it, net interest income is 402,718.
Okay.
So I'm sorry. So that what 263 is the expense. You subtract the expense from 665 above to get net interest income of 402.
Got it.
Okay. So that is one source of revenue. That would be the same as if you had a retailer that put like menswear as one line item and then women's wear as another line item. Okay. So that is just menswear, essentially, interest income.
Okay.
Then you have non-interest income, and that's total net revenue. And you'll see total non-interest income is 242,277.
Yep.
And then if you add those two numbers together, you get the 644.
Got it.
So every single set of financials will typically have at least these two categories, net interest income and then non-interest income, and that will be your net revenue. And that's how you should look at it. The data feeds oftentimes will just get this wrong across banks because they don't know which one of these to pull. None of it says revenue, sales, or anything else.
Right.
And then interest is actually something in places you subtract and then add, and so it just explodes their data feed taking in. Some have gotten better, so I will say I'm very impressed. Sometimes I see it correctly, but I don't see it correctly enough to where I wouldn't double check all of these numbers. Okay. Now the other thing is if you scroll down, you'll see provision for credit losses. In some banks, provision for credit losses comes above, and in other banks, it'll come right here. Most banks now put it below the total net revenue. But provision for credit losses is an expense that would be like an operating expense. So
That's basically what they're earmarking in case they need to write something off.
Yes. And also, you'll have to kind of note that if you're doing fair value, then the losses in theory should, especially since he has said before that they take sales marks, which apparently some of the bears didn't realize that if you're taking a sales mark of the market price, that is actually the definition of mark to market, meaning like I'm selling it for this, so I'm marking it for that, right? But it's okay. It's okay. Everybody has a different learning curve. It's fine. So since they are in fact doing mark to market losses, this should be accounted for in the balance sheet. Now, the bears are saying that credit loss number is too low. Who knows is the answer to that question. They came in at, I think, 5% versus 4.88. Basis points do matter. Their argument for why it came in the way it did was because they had a couple of issues. The first is that the loans are actually being paid off quicker, so it changes the whole math of the duration, such that if the loan defaults, it defaults earlier, so the defaults come closer to the front, and then it smooths out to the back. That actually is a thing, believe it or not. So from a risk perspective, within 1 or 2 quarters if they're lying on that, okay? The other thing is that you do actually need to re-up the portfolio if you do have what's called prepayment risk. And so that can also change the math because it modifies the denominator a bit. Okay?
Yep.
If you had the same, and it's a little bit funky, but that's why, but so if you've got a number 8.4 coming in at 7.1 the next quarter, they're telling you that the loan book is not growing, but you've got the percentage of that loss being higher. It could be because your denominator is decreasing, okay? Which is what they're saying is happening with prepayment risk. This is why I don't know is the answer to the bears, but your argument does have some weakness, some significant weaknesses.
Based on your review of this, May, was it just growth that was the primary driver in their EPS going from negative to positive?
Yeah. Basically, they scaled themselves. Banking is absolutely 100% a scale business. That's why the other banks are struggling right now. If the other banks could write new fabulous loans, then they could get rid of their old loans by just blending out a rate on a securitization. It's not ideal, it's a little dirty, but that is the nature of this business, right? Because here's the thing, they could do that only because we've had a really good economic growth, and basically you're not getting defaults. So the default rate hasn't been crazy off the charts such that you can't even do the math on it because it's been escalating so ridiculously on this type of credit risk. Okay. If we were talking subprime, that's a totally different story. Those guys are experiencing a totally different situation. But at the super prime level, it's a little bit of a different animal, right? Like people have actually been paying back their debts, strangely enough, and we do see that. Additionally, the other metric that in general is just important for all of banking is where have credit losses gotten to? And yes, credit losses have increased and escalated over the last year, but they've really come back. This last quarter, they came back just to where you would have seen them in 2019, 2018. So they're back to normalized historic levels. We had helicopter money. We had a decent situation in wage growth. Now, as we go into, and this is more on the macro banking side, as we go into this quarter, if those first banks that come out, if they're seeing highly elevated credit losses, that's going to be bad for everyone, including SoFi.
Right.
Because, just because this credit rating is higher doesn't mean that they're completely oblivious to any credit losses.
Yep.
Yeah.
Yep. I hear you. So pay attention to the first banks that are reporting is what you're saying.
Yeah. That's why the banks, when they come out, are such a, they really throw off a lot of macro evidence for the entire economy as well as the rest of the companies to come thereafter them. It's why, even though you do have companies that have reported this month and will report in the next 2 weeks, the banks really, in my opinion, kick off earnings season.
All right, let's take a break from the eye-bleeding balance sheets for just a second and talk about some of Rolf's questions here and comments.
Okay.
He said, since December 2022, SoFi has struggled to get $10 and has been unable to maintain anything above that. Feels like it's stuck orbiting around the price that it's at now. I'm going to put the chart back up here again. And then his next question, follow on to that comment, is what events or catalysts or fundamentals are we going to need to get SoFi back over $10?
Okay.
I'm going to put the stock chart up here one more time.
So I do think that there are a host of opinions on this. But one thing to note is that SoFi isn't in any of the major, they call them investable indices, because it's a little bit of a snotty way to say it. But the MSCI and S&P indices really are the best indices to be in if you're a company trying to get institutional investors. And the reason that they're great is because you will end up being forced to own them. A lot of the S&P series and the MSCI series are benchmark series. So let's say you're a pension fund and you've decided that you're going to allocate X percent to mid cap. Well, you would then call up either S&P or MSCI, and you would make that your benchmark, and any analyst or manager would have to manage that benchmark. SoFi isn't in those indices, and once it's in those indices, you will get a whole new set of people that analyze this stock. And in order for it to get in that indices, it simply needs 4 quarters of positive earnings. It has, it could, in theory, if it pre-announced, do that in September. I don't think it will. Okay, so even I'm not that crazy bullish that I'm saying for sure, but I think by March it's got a very solid shot of entering and complying with all of the criteria for S&P and MSCI. It will probably go into mid cap unless something truly insane happens. But once it does that, I think you'll start to see a much more stable behavior by the stock. A lot of that will have to do with the mix of retail versus institutional ownership. Right now, this company just gets way too much short interest, but that's harder to do if you've got a lot of net buying because it went into a major index. Now, some people will say, well, it's not going to the 500, so it doesn't have that asset flows. However, they oftentimes forget that given the market cap, it would then be a very large component of the financial segment of the S&P mid or the MSCI mid cap.
I'm pulling up. I don't know what the short interest is on SoFi. Oh, around 18%. Okay.
Yeah, it's been as high as 34.
Wow. Rolf, do you have any follow-up questions based on her answer there? And May, you said you're long on SoFi, and what else do you have?
I do have options, but I have them like into late 2025, 2026.
Okay.
I don't see. Here's the thing: is the bear argument has nothing to. Usually, bear arguments that I know and love, they all say the company's going bankrupt. The bears are not suggesting this company goes bankrupt. They're suggesting that the balance sheet is incorrectly stated, and they're using a securitization argument that is a little bit. It's complicated, for lack of a better way to say it. So
John?
I don't think any of the bears are suggesting this thing is going bankrupt, which is strange for this stock to get so clobbered and to have such high short interest. Yeah, they would be leaps, hide and seek too.
John is asking, what is the average FICO score? I remember seeing a table in the earnings, May, with credit scores. Yeah, let me see if I can pull it up and let's see.
I might have missed it. It happens. I miss stuff, guys. That's why I love doing social media and having
I don't remember how I can find it, but there was a table in here somewhere that showed average credit score for, I think it was for I don't know if it broke it out by the type of loan, but it was fairly a pretty wide mix. Here we go. Here's credit cards. This is the one that I remember seeing. This was credit cards.
There you go. Yeah, you could probably do some kind of weighted average here to get the average. Yeah.
And let's see if they have it for anything else.
Oh, wow. Okay, I didn't see this part of it recently. I know
this is a small amount of their
total book. Yeah.
Yeah, of their total book. So I'd like to see a table. Let me just do a search for FICO and see if I can find anything.
Yeah, I think if you were trying to do this for yourself, like, because you have a lot of folks that always help out. If you bucketed it to like 700 plus, 650 to 700, and then 600.
There we go.
There we go. Oh, there we go. That's why 740. Yeah.
I hate when I zoom in and the page I was on jumps off the screen.
I know. There we go.
Loans with a balance and average loan balance. This is still a small amount.
Yeah.
But 746, 768, and 751.
Yeah. I didn't realize they added this. I haven't had a chance. I've been so busy recently to look at this, but this actually is better.
I was surprised on the credit card how much they had under $599.
Yeah.
But I mean, compared to everything above it, it's not overweighted.
Less than 10. It's just a little bit over 10%.
Yeah. So maybe that answers your question. This is all, I can only find these two tables here. This one for credit cards and this one loans with a balance. and it's got the scores here.
Yeah.
Overall average 750. Someone was asking me, May, and I don't know the answer to this question, about the buy now, pay later thing. Is that something SoFi recently got into?
I don't hear much about it, so I don't have a really great thing to talk about as relates to that. Oh, Vadim 72 for the weighted average originations. Thanks, Vadim.
Yeah, that's this table here. So yeah, I'll have to look into the buy now, pay later, because I do worry about that on some other businesses where that is their entire business, like a Klarna or something like that. But
Yeah.
if it's only a segment of SoFi's, I worry about that if the economy continues to deteriorate. But if it's not your primary source of revenue, then you have to kind of weigh it relative to everything else that they have going on.
Yeah, I don't hear much about it. I'm not going to pretend like they do have a lot of new products that come out. So, maybe others that can confirm that, feel free to post. I know PayPal has one, and it always scares me, to be honest.
Yeah. Yep.
Like,
all right. Any other questions, guys? Let's see if there's anything else here on the earnings. And then I want to look at real quick before we wrap up, May, I just want to look at the analyst forecast for SoFi.
I really a lot of these analysts are asleep, and they put that in there ages ago. I'd love to.
Yeah. There's one thing, like I always tell my guys, when you're looking, people post these charts. Oh, analysts are saying $14 for X, Y, or Z company. First of all, there's a chart. But guys, I want you to get in the habit of, once you see the chart, you need to dig deeper. Like how recently were these estimates made? And on a website like stockanalysis.com, you can go, or any of them, you can go down and look at the date of when the ratings came in. Like I see, oh, Mullen, they have an $80 price target, and it's at $2 right now. Okay, well, what happened with Mullen? The analyst rated the stock when it IPO'd 3 years ago, and no one's updated the price target since then. So don't just go by somebody's screenshot on a price target. First of all, that's my general recommendation. Always do your own DD, and I like to see recent price target updates, especially after a company releases earnings. So when did this Q1 come out, to the earnings? Wasn't that in May?
May 30th, I think. Was it
May 30th? So
wait, hold on. I've been looking at a lot of different things for my class recently. Let's just double check that. No need to guess with the Google.
Most of these price targets that we have here were from April and March.
Yeah, I know they reported a little later. Let me just look that up.
And this David Chiaverini is the one that's getting a lot of controversy right now with his $3 price target.
April 29th.
April 29th?
Looks like it, yeah.
Okay, so we had 3 analysts that updated their price target after earnings. 2 of them have a $10 and $11 price target over the next 12 months. And then our buddy David saw the same information and said $3.
Yeah, they're part of the folks that believe that the fair value accounting is completely the end of the world somehow. And maybe they're right. We shall see. And the thing that you would look for is not just a sudden, strange report. You should start to look for a series of things that start with the inability for them to move things off balance sheet.
I would also say, just in general to the audience, and some of you guys that are full-time SoFi followers, you've probably already done this, but like the next work that I would do would be go see if I could find these guys' reports or an interview or a news article to see what are their thoughts, and compare David, Kyle, and Mark. What are they looking at so differently? in so many stocks, we get a analyst report that we don't like, and we just say, oh, well, he's obviously, being paid to short the stock. Maybe he is, but you should go in and still read and see if you can get in his brain and see if anything he's saying makes sense.
Yeah.
And May, you're saying that the bears on this stock basically are saying that SoFi is presenting inaccurate books. Is that a fair way to
Yeah,
summarize it?
they think that the marks on the book are overstated. So, if we're using book value, which I'm actually comfortable with using book value, and I'm comfortable with using book value because if you look at, if it weren't for this issue, the deposits have grown so dramatically. And such a weird thing too, because deposits have grown so dramatically, and it's not like they're arguing that the loans aren't the type and mix of loans that exist, you know? So if they were saying, oh, they're giving mortgages out and they're taking out debt at 4% and they're only giving mortgages at 5%, and then the losses will compensate for that spread, I'd be like, interesting. Could be, right? These are personal loans. These are personal loans. They're being done at 9+ percent right now. And they're being done at 9+% because they can.
Yeah.
And also their credit card receivables, which are done even higher. So you've got that. And then your funding cost is still your funding cost, which actually went down as a function of the converts. In order for me to really feel passionately that you're right, that the held to maturity, the stuff on book is mispriced and wrong, I'd really have to see them fail to be able to get anything off balance sheet. And so then they make these very unique arguments about how the credit spread this and what have you. And I'm like, they're still selling these things. Like they're still like there's still a buyer for the securitizations, you know?
May, am I safe in guessing that your average bank doesn't have a short interest of 18%?
I mean, some do. The ones that do are more like actually having. So just to give you a sense for it, you can calculate 9 and change minus 4 and change. The net interest margin of that is like 5, right?
Yeah.
So 5 plus, and depending on once you do it right. Okay. Do you want to take a guess at what the net interest margin was for Fifth Third and most of the banks right now? I'll give you a hint. Most of their loan book is mortgages.
Help us out.
2. It's around 2. And when a bank goes below 2, it gets really dangerous because if your losses tick up, remember, I told you this is more like gross margins. This is not operating margins. You still have enough to operate the bank. So that's why I'm like, what are you talking about? Whatever they're saying for SoFi is so much more problematic if we move it from SoFi to like other banks, especially the regional banks.
Right. The thing that I like about SoFi just as a trader is I feel like it has, if they can catch a break, if the other banks and the economy and the Fed don't take us down, that in the financial sector that there is these potentials for more wild swings in the stock price. SoFi was just at what, $10-11?
Yeah.
Not too long ago.
It just needs more quarters of consistent performance. We guide, we either make or beat, and then profitable. And over time, the volatility will come out of it. I do think in a dream world, you would also switch to CECL from fair value. It wouldn't make sense to do that until you get rate stabilization because you've got to get rid of parts of your old book and then you're still bringing in new book. And then if you have a split accounting methodology, if you think this is hard to understand, like it would be, so at some point later, you will see them switch. That's a known situation. When will that switch happen? Like, even I'm kind of like, I wouldn't do it until we're through this very awkward rate environment that's happening right now, because it would look insane, for lack of a better way to describe it. It will look insane on the financials for a lot of the reasons that the bears are saying. But again, because it changes so many different spots, I'm not convinced the bears have, like, most of the time when I look at them, they're holding all of these things as assumptions to be true. But the minute you were to do the type of accounting switch that they're asking for, none of these assumptions would be true any longer. And also, they're assuming that you would never be able to sell loans off balance sheet, which would make sense if you believe that that's going to happen across all banks. But realize these are higher credit quality loans. So out of all the banks that are going to have a problem, you're way worse off at the others than you are at SoFi. So I really do. That's why I'm like in the back half of 2025, because these things do have to work out. If they do this really weird accounting switch, given how crazy some of these bear analysts have been, you may see them nitpicking and doing some nonsense associated with that. It's an overhang in the stock. You do know I am not as constructive as other people on this coming quarter as relates specifically to the financials. I feel a little differently about other companies in the marketplace and where they will sit, namely our other favorite, AMC, which we talk about a lot. I think they're going to have a great quarter, quite frankly. But so I think it's very stock by stock. But if we were to say which industry will be very controversial going into this next quarter, it will absolutely be the banks, and specifically the regional banks and financials that make loans. All of them are going to have a rough quarter. Sorry, let me say that differently. All of them will have to prove themselves this quarter because they did not get a lot of macro help. Let me say that. So either they guided correctly, they guided too aggressive, they guided, what have you. And then, so just the guidance piece is a real controversial part going into the financials earnings reports. And then you have the actual performance piece, which is not going to be so straightforward because you have a known event that's going to happen, and you have banks that are not necessarily high stacked coming into the table that may try to take advantage of the declining rate environment, even though you have a lot of macro unknown. So did that make sense the way I'm saying it?
Yep.
Okay. Do you want me to say it like one more time a different way, maybe to try to?
No.
Okay, good. Okay,
I think, basically you're saying it's a little bit speculative going forward. That's how I'm going to summarize it. We'll have to see.
It's going into this quarter in particular.
So I just started going back into SoFi after selling in November 2023 after that big run up they had, and it started melting back down. I was like, I'm going to lock my profits in, but I'm not going heavy into SoFi in case that the worst case, if it drops to $4 range again, $3 like that our bear analyst says, well, then I'll analyze the financials and the fundamentals, and we'll see where we're at then. It won't make me hate SoFi. I always want to get the best entry possible, as long as I still believe in the company over the next 2 years. That doesn't scare me away. I just got to make sure there's not like bankruptcy risk or something like that.
Yeah. To me, if the argument was I'm bearish all of the banks, every single one, and therefore I'm also bearish SoFi, I would actually be okay with that. I wouldn't argue that. You know what I mean? That would be the same, and feel the same way on the theater business. If you really were bearish on all the theater, then I could understand why you'd also have a corresponding sell view on AMC. Don't do that though, because you should be bullish theaters right now, given what we're seeing. Maybe not. I don't know.
No, I mean, Q2 really turned around here in the last 3 weeks for the movie industry. Right? Yeah. Harold says, can you comment on Walgreens? Is it a good buy? Harold, back in August of 2023, I looked at Walgreens versus CVS to decide to cover one of them on my channel. And at that point in time, I opted not I looked at CVS, I looked at Walgreens, high level, decided not to cover Walgreens. I didn't like what I saw. So I am providing coverage on CVS. I own CVS. I trade CVS. It's still a problematic stock right now.
Yeah. Started looking at it though.
Yeah. So check out my coverage on CVS if you would like. But what I will say about Walgreens after that huge drop that they had last week, it's back on my radar.
Yeah, me too.
Yeah, because I like good companies that are out of favor for whatever reason. The lower it goes, the more interest I'm going to have in maybe providing some future coverage on it. And
Yeah.
I think, let me pull up the chart. I think that wait, not this one. I think that I put a price target on Walgreens. No, maybe I'm thinking of Nike. Nike got spanked too.
Yeah.
Maybe I'm thinking of Nike, but
Thank you, YOLO.
let's see if I ever put a price target where I'd really be interested in Walgreens. I
Ooh,
did not.
okay.
I did not. But Nike is another one that about a year ago, I said if it ever drops to $66.98, I'd be interested in buying. Look how close we are down here. We're almost to the point where I'm going to start doing some coverage on Nike if it gets a few more days or weeks of bad news. So.
Yeah. Nike will figure it out eventually.
These companies, they're not idiots. They take some short-term spankings, but if you look at the long-term trend,
yeah,
I don't worry about a Nike going bankrupt. I don't like overpaying 173. This was just ridiculous.
yeah,
And I probably drew this line when it was around 110. And who would have thought that you'd see almost a 50% drop in a year?
yeah.
That's all I'm waiting for. I might wait a year or two to get in stocks. Just give me some bad news. Give me the news that makes everybody run away from these stocks. That's when I want to go in. As long as I don't think they're going bankrupt, as long as I think that management can turn these companies around in 1, 2, 5 years. So maybe you'll see some coverage for me on Walgreens in the future.
Yeah. Both of those hit my radar screen too, because that was really aggressive in response.
Yeah.
I think between the two, I'm kind of more intrigued by Walgreens right this minute. That'll change tomorrow possibly because that impairment charge, to me kind of looked like they're finally done. It looked to me like the overhang in the stock has to do a lot with the pharma business and the awkwardness of what their strategy was and how badly that did not work out for them. So taking the impairments like a champ finally suggests to me they might actually understand that finally. You know what I mean?
I need to go in and see today if I can figure out what price I like Walgreens at. Look at that, man.
So
$70 down to 12.
Yeah.
That is crazy. That's crazy.
Clobbering it.
Yeah. I mean, there might be a screaming buy on Walgreens right now. I guess at the time I looked at it, it was August of 2023. It was at $28. So that's a huge sell-off. And we love bottom feeding on this channel.
I'm such a bottom feeder as far as that goes. Favorite names. They really are the ones that you can set and forget if you do them right.
That's what I try and tell people, May. If you guys can identify good companies that have a long history of growing revenues and mostly growing profits, and catch them on a downtick because of some short-term bad news, those become your set and forget, and you can sleep at night because that company is likely not going bankrupt.
Yeah.
It's just tick-tock, how long till they figure it out, and when management figures it out, then you get these massive moves up. And it's so much more comfortable buying something like a Walgreens or a Nike or a Target or a Disney or Bud, whatever, when they're out of favor because they fuck up, and you buy them when everyone else is running away, and then you just sit back and smile and wait, and they have these massive run-ups when management figures it out, or it becomes so undervalued that institutions start coming back in and buying. So I'm just saying it's easier to sleep at night looking for those deals than trying to pick a money-losing stock like a lot of the plays that retail favors, that has a long history of losing money. pick your ticker. You guys know the ones I'm talking about. Any ticker that anyone's asked me about for the last 3 years on this channel. Those are your super risky plays. I enjoy playing those too,
Yeah.
but not with the majority of my portfolio.
Yeah, I think you have a little bit of time to just kind of really feel comfortable. And that's what intrigues me about taking a look at it, in the next month or so. Walgreens and Nike, they will eventually have another quarter and you'll be able to see the progress of it. So I think with Walgreens, I kind of want to do my work before next quarter. With Nike, and I mean, the only thing with Nike that makes me want to do my work faster than sooner is if they somehow manage to just do a little better because of the Olympics. Like,
Yep.
But it really bothered me that they reported this way in front of the Olympics, because the Olympics historically has been so great for them. And this is basically, it kind of just sounded like they don't have it this year, which is insane.
Well, both of those are on my short-term list to dig into now, May. I have some other value stocks that I'm working on for future videos, but Walgreens and Nike are getting bumped up to my list because the other ones are more dodgy companies. I'm kind of like dumpster diving, looking for undervalued.
A good one, right? It can be.
I'd rather go in on something like this,
That's true, because then you could. Some of the ones where I've done this, especially in 2009, 2010, I've never sold them. They're still there. You know what I mean? Darden, I haven't had a chance to look at yet. I'm actually reviewing the quarter before the end of the week, so I might be doing that in a couple hours or so while I walk around the heat.
Getting back to SOFI, and I don't want to tie up all of May's Sunday because I know she's busy. Do you guys have any other SOFI questions while we're still both here? And did you find any of this useful? I mean, I think May and I are both kind of in the same boat. We're both long SOFI right now. We're both considering it speculative. We need to see another quarter or so, but we're not negative on SOFI's future. We're just kind of like,
you got a funky period right now. I mean, I think if you're like, listen, I can't be taking risk, I would just monitor it and watch for as the news flow starts to think about it going into an index. And then for sure, it's just the buying pressure will stop the nonsense on this one. So if you were like, I'd like to get closer to that is, I'm not a technician, so I don't think that way, but it is true that when a stock starts to be a consideration for an index, you will get a big buying push no matter what. So
I started my first coverage of SOFI May back in April of 2022 when coincidentally it was around the $6-7 level. I think it was at 6.30, and then I stopped covering it because it ran up so much. And I was like, I don't really want to provide coverage on something that's running way up because I'm selling. I was getting out of the play. It's now at a point where you might start seeing some quarterly coverage from me, or maybe more often if there's some good news out of SOFI.
It is, in my opinion, a better company because it was doing the same fair value accounting then that it is now, given that it came from a fintech world. It's just that the bank is significantly bigger. They really did benefit from Silicon Valley Bank. They had 90+% FDIC insured. So they were safe as far as that goes they were safe relative to even a local regional bank who didn't have anywhere near that on insurance, on deposits. And they just I wish the Bears would actually give them credit for the market share that they took. It was huge. But they don't. And that is what it is. Bunch of jerks. Sorry, Bears. I'll always be like, when you're shorting my stocks, I'm always going to call you a bunch of jerks. It's not personal.
Andre's asking, do you have DRI in your portfolio? Darden. I do not.
I don't have Darden, but I review it regularly. I wish I did. Darden is basically Olive Garden, I think. Capital Grill. Do I have it right? Let me know if I've got you wrong on that. But I think Darden is Olive Garden, Capital Grill, and a couple of other restaurants. Cheddar's, is that what it's called? PE
ratio 17. So they are Olive Garden, Longhorn Steakhouse, Yard House, Ruth's Chris, Cheddar's, Capital Grill, Eddie V's, A lot of nice restaurants there. A
Yeah, they've managed to
lot of
do
popular restaurants.
yeah, they've managed to do a lot of really smart things, and I wish I would have been smarter, but I always was like, "Ooh, can I get them for cheaper? Can I get them for cheaper?" And
They
the
have
answer
a
is
beautiful
well.
chart. I mean,
Yeah,
it's nothing but net here. It's
yeah.
going up.
They've operated a great business. I mean, I missed that one like a champ, but and that's even though I was like, I think they're gonna do fine. I think they're gonna do fine, but missed it like a champ. Sucks. But
Yeah, I don't own it, but I like some of their restaurants.
I'll put Andre, I have to review the quarter anyway, so I'll post something on Twitter soon if you just want to see how I'm looking at the quarter. Thank you for asking one way or the other. We always like questions on this show, and
Anya says she's just going to be patient with SoFi. I think that's the right thing, Anya. And if you like SoFi, if you're already in it and you're handed a dip down to the $3 or $4 range, let's take a tougher look at it if that happens, and we'll decide is that the point to double down or not? Do we still believe in it long term? And if it manages to come out unscathed over the next couple of quarters, and
yeah, then it becomes more interesting for sure. I
yeah,
agree.
then we get a payoff for wherever you're at right now, and I'm at very close to the current price in my SoFi, and I probably will add. I think you guys know how I do. Once I get an entry, I either need to see it hang out there for a while, and I cost average in, or if it starts dropping 10 or 15%, as long as I still believe in it, that's kind of like my next either 10 or 15% from my initial entry. If it drops down, or I look at the Fibonacci chart, and I think that's around 607. So about 10% below where SoFi's at right now.
I will say this
605.
on SoFi, and this will make it crazy volatile for a bit. There are some folks that are on the option side that have been pinging me with stuff, and I don't want to try to like muddle it because honestly, I don't even know that I could explain what they're seeing in the same way. But there is kind of some crazy stuff going on the options this week bullish, last week bearish. You know what I mean? So it's starting to have the same dynamic because at this dollar value level, it just does as like AMC and GameStop, and it's all like on the option side. It has nothing to do with what's actually going on with the company. So if you're looking to enter or exit and then re-up, just realize that it will be the same weirdness that you see in some of those.
Yeah, I see a lot of open interest on the $7.50 and $8 calls.
Yeah.
For next week. We'll see. Yeah, I haven't even looked at or thought to look at the options table on SoFi, but that comes with the territory of kind of being a retail stock, right?
Yeah, it does. It's really kind of funky. It wouldn't be my reason, but for those of you, I know that there's a lot of people that care. So have a look, enjoy, let me know what you see, sort of thing.
Last question. Someone asked about PayPal. I have previously owned PayPal. I don't have any right now.
I actually do own some PayPal right now, small, and I don't know that I'm going to increase in size. And it's really more of a monitor for me long term. I've wanted to own PayPal. I actually was short PayPal like crazy from the 200 and change level because I didn't like their strategy. But Elliott Management came in and started buying them and forcing them to make that company profitable and forcing them to integrate properly so that you could actually get economy of scale. So all of finance is about scale. And PayPal technically has scale, but it keeps doing it for a long time was doing dumb stuff. I don't know another way to say it. I think that they've righted the ship on that. However, they've done it right into a period where payments in general, the volumes are slightly down globally. And you kind of see that Visa, MasterCard, even though you're still seeing good growth, you still see good growth on the payments, and particularly the cross-border payments is the jargon word. Even though you still see that pretty decent American Express, Visa, MasterCard, none of them have certainty on that until we get better certainty on what's going on between us and China, quite frankly.
It looks like their forward PE ratio is so low, May. If they can,
that's why I wanted some.
yeah. If they can turn it around and give people a reason to believe in the company, you could get a premium on the earnings and get a nice little boost in price. So.
And also, no question whatsoever, if we start to get quantitative easing globally, the payment processors, of which PayPal should be included in that. I think they now are called something else. But Visa, MasterCard, PayPal would be the biggest beneficiaries of global quantitative easing, period. Because they have huge margins. They're hugely leveraged to volume. They are absolutely economy of scale players. So if you are very bullish global economy, you don't think that we're going to take this nation and every other nation into it's a little scary going into a president election. We're not going to try to turn this into a political discourse, but if we end up in 2025 with this beautiful brave new world where everybody starts to be friends again, then absolutely PayPal's massively undervalued. PayPal's reflecting that uncertainty right now in an ugly sort of way.
I guess my macro concern with PayPal is that they're losing ground to all the competitors out there. So I haven't looked at that, at a macro level in 6 months or maybe 9 since I got out of the play. But I wouldn't be opposed to taking a fresh look at PayPal, especially with the PE ratio of 11.45.
Yeah. You have at least through the election, because I do think it's the macro that's holding these guys down right now.
All right, May, do you have any closing thoughts? I don't want to tie up your entire Sunday.
I really appreciate it. Thank you for helping me actually stay on my social media. I've been so overwhelmed these last few weeks.
Thank you, guys. Thank you, May, for your time. And I think, it's Sunday. I didn't do a live stream Friday or Saturday night. So you guys will probably, if you, want to hang out, have a drink and a smoke, and cut up and have some fun later tonight, check for live stream later.